do you actually know why you own the stocks you own? Not the ticker symbol, not the tip your cousin gave you at a wedding. The real reason, the business reason, the one you could explain in 30 seconds without checking your phone. Most people can't. And Peter Lynch, the man who turned Fidelity's Magellan Fund into the best-performing mutual fund on the planet, built an entire philosophy around that one uncomfortable gap between what we own and what we understand. Lynch ran Magellan from 1977 to 1990, and during that stretch, he delivered an average annual return of roughly 29%, a number that turned a modest $20 million fund into a $14 billion giant. He didn't do it with insider access or a Harvard trading desk. He did it by walking through malls, listening to his wife talk about pantyhose, and treating ordinary life as raw investment intelligence. This book is his case file on how an amateur beats a professional, and by the end of it, you will never look at a shopping trip the same way again. 2 questions will trail you through everything that follows. The first is why the very training that makes someone a professional investor can quietly become the thing that ruins their returns. The second is even sharper, and it has nothing to do with the market and everything to do with you. Both questions only fully resolve near the end of this masterclass, so stay with me, because the answers reshape how you'll evaluate every investment opportunity you encounter for the rest of your life. The strategic breakdown, the amateur's edge. Now we open the file on the first piece of evidence, the chapter titled The Amateur's Edge, the one Lynch considers the entire foundation of his philosophy. Professional fund managers operate inside a cage they rarely admit exists. They work within a rigid structure of guidelines and exhibit a propensity toward homogeneous thinking and strategy. A pension fund manager can't buy a stock until it's already been blessed by a committee, rated by analysts, and approved onto a pre-cleared list. By the time that stock reaches them, the real opportunity is already gone, eaten by everyone who moved first. You don't carry that cage. Inside the vault, we call this the amateur's paradox, the idea that your lack of institutional permission is actually your greatest asset. Lynch spent 20 years proving that any normal person using the customary 3% of the brain can pick stocks just as well, if not better, than the average Wall Street expert. Read that again, not despite being ordinary. Because of it, you already crunch. Data professionals get paid to chase every time you decide which grocery store deserves your money. Here's where it gets uncomfortable. You've probably spent more time researching a used car than you have researching a stock you own right now. You know the mileage, the resale value, whether the dealer's lying to you about the transmission, but you bought $400 of some company because a headline scared you into it. That gap between the diligence you give a car and the diligence you give your savings is exactly where most portfolios quietly die. And Lynch built his entire career exploiting the fact that almost nobody closes it. Investment opportunities are everywhere, from the supermarket to the workplace, and Lynch's core claim is that individual investors have a unique window into that world before Wall Street analysts ever notice it. Think about the last product that genuinely impressed you, a coffee shop with a line out the door, a store that keeps expanding into every strip mall in your city. That's not gossip. That's a signal, and signals like that are precisely how 10-baggers, stocks that multiply 10 times over, get discovered by ordinary people long before institutions catch on. But an edge without discipline is just a lucky guess wearing a suit. This is where mainstream advice collapses because most people hear invest in what you know and stop there, buying a stock the moment they like a product without ever opening a balance sheet. Lynch never meant it that way. He meant know what you own, meaning do the actual homework behind the familiarity. The next piece of evidence in this file is about exactly that, about whether you're even ready to walk through that door in the first place, the mirror test. Now we move to the piece of evidence Lynch places before any stock talk begins at all, the chapter titled The Mirror Test. Before you study a single company, Lynch insists you study yourself, because before you start buying stocks, you need to think through certain fundamental questions about your own financial house. The first of those questions is almost insultingly simple. Do you own a home? It sounds unrelated to the stock market entirely, and that's exactly why most readers skip past it without understanding why it matters. Buying a house helps you understand the research that you need to buy stocks, because a home forces patience most people never develop with paper assets. You don't panic sell your house because the neighborhood had one rough month. You ride out the noise because the asset is tangible and the timeline is long. Lynch wanted you to bring that exact same temperament into equities, and the truth is, most investors never do, which is precisely why they buy high in euphoria and sell low in fear. the opposite of what actually builds wealth. The second question cuts even closer. What is your edge? Not your neighbor's edge, not the influencer's edge, yours specifically. What space do you actually understand better than the crowd? Maybe it's your profession. Maybe it's a hobby you've obsessed over for a decade. Maybe it's simply the industry you've worked inside long enough to smell when something's changing before the headlines catch up. If you can't answer that question honestly right now, pause and actually answer it, because everything else in this file depends on it. The third question is about money you can actually afford to lose, separated cleanly from money you'll need in the next 2 or 3 years. Lynch was blunt about this distinction because the market doesn't care about your timeline. Only you do. Someone who invests rent money in a volatile stock isn't investing, they're gambling with a countdown clock. And no amount of research changes that math. The vol perspective on this is different from what most finance content tells you. Discipline isn't a personality trait here. It's structural, built before you ever open a brokerage account. Once those 3 questions are honestly answered, the mirror test is complete, and something shifts internally. You stop asking, "What should I buy?" and start asking, "What do I already understand better than anyone else in this room?" That shift is the actual beginning of Lynch's method, not the stock picking itself. And once you know your edge, the next piece of evidence shows you exactly where to point it, because not every stock behaves the same way, and treating them as if they do is how good investors make catastrophic mistakes. The 6 tribes of stocks. Now we open the third piece of evidence, the chapter titled The 6 Tribes of Stocks, the one Lynch built to stop investors from judging every stock by the same yardstick. Lynch introduces a 6-category stock classification system: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays as a tool to tailor investment strategies. This single framework quietly separates people who lose money from people who compound it, because most portfolio disasters happen when someone applies fast grower expectations to a slow grower stock or panics through a cyclical downturn as if it were a permanent collapse. Slow growers are the retirees of the stock world, large aging companies that pay generous dividends because they've run out of exciting ways to reinvest their own cash. Stalwarts are the steady middle class, companies large enough to survive recessions but still capable of moderate growth, the kind Lynch kept as ballast in his own portfolio during turbulent years. Fast growers are the ambitious younger sibling, small aggressive companies expanding 20 to 25% a year, the category most likely to produce a genuine tin bagger if you catch one early enough. But here is the truth that should stop you cold. The category you misread will cost you more than the stock you pick poorly. Cyclicals are where amateur investors get destroyed the most, and Lynch says so directly. Cyclicals are the most misunderstood of all types of stocks, and it is here that the unwary stock picker is most easily parted from his money in stocks that he considers safe. An airline or an automaker looks rock solid during a boom and then collapses violently the moment the economy contracts, and the investor who bought it believing it was a stalwart gets blindsided by a category error. Not a bad company. Then there are turnarounds and asset plays, the 2 categories built entirely on contrarian nerve. Turnaround candidates have been battered, depressed, and can barely drag themselves into bankruptcy court. And these aren't slow growers, they're no growers. Yet the ones that survive their crisis often snap back faster than any other category because the market overcorrects on the way down just as violently as it overcorrects on the way up. Asset plays hide value the market hasn't priced in yet. Real estate, cash reserves, or patents sitting quietly on a balance sheet nobody bothered to examine. If you leave with nothing else from this video, leave with this. The question is never simply, is this a good company? The question is, which of these 6 tribes does it belong to, and am I judging it by the right standard? A slow grower that pays a steady dividend isn't a failure for growing slowly, and a cyclical isn't a scam for crashing during a recession. They're simply behaving exactly like what they are. Once you can sort a stock into its correct tribe, the next piece of evidence in this file becomes far more powerful, because now you know what specific signs to hunt for inside each one. The 13 signs of a perfect stock. Now the file opens to what Lynch himself calls the practical heart of the entire method. The chapter titled The 13 Signs of a Perfect Stock. This is where the amateur's edge in the mirror test and the 6 tribes finally converge into action, because Lynch built a checklist of traits, 13 in total, that repeatedly showed up in his biggest winners. And the first sign is almost comedic in how simple it sounds. The company should be boring. A dull, unglamorous name that makes people's eyes glaze over at a dinner party is often exactly what keeps Wall Street's attention away long enough for you to get in first. The second sign runs even deeper than the name, into the actual function of the business itself. If the company does something dull, something with no exciting story to tell reporters, that's often a second layer of protection from institutional attention. This is the anticipation gateway worth pausing on, because it leads directly into the story that made Lynch's philosophy famous outside the finance world entirely. The story that proves this isn't theory. It's exactly how he built his career. One day, Lynch's wife told him how much she loved a new product she'd bought, Legs Pantyhose. He looked into the company behind it, liked what he found in the fundamentals, and bought the maker of Legs Hanes, ultimately watching the stock appreciate 30-fold, not because he predicted a macroeconomic trend, because he paid attention to a conversation most husbands would have let pass through one ear and out the other. Lynch found a similar pattern with the Gap, investing based on his wife and her friends' genuine enthusiasm for the brand's clothing, proof that domestic, ordinary observation kept outperforming Wall Street's spreadsheets. But this same instinct has a dark mirror, and Lynch never hides from it, which is precisely why this file stays honest, instead of turning into a highlight reel. Colco's Cabbage Patch doll was the best-selling toy of its era, yet it couldn't save a mediocre company sitting on a bad balance sheet, and although the stock rose dramatically for a year or so, the excitement alone couldn't rescue what the numbers underneath refused to support. A hot product without healthy fundamentals is a trap wearing the exact same disguise as an opportunity, and Lynch wants you to feel that danger before you ever mistake enthusiasm for evidence. Lynch's own words tie the entire chapter together better than any summary could. In a Yahoo Finance interview reflecting on his career, he explained his conviction in Dunkin' Donuts this way. During recessions, he didn't have to worry about low-priced imports, and people were still there, buying coffee, which is why he ended up making 10 to 15 times his money on that single position. That's the entire 13-sign checklist compressed into one sentence: a boring business, a resilient customer base, and numbers that back up what your eyes already noticed. The deeper layer most readers miss is that Lynch never separated observation from arithmetic. He fused them, and that fusion is what the final piece of this file reveals in full: the long game. Now we reach the final piece of evidence in this file, the chapter titled The Long Game, the one that determines whether every previous chapter actually pays off. Because finding the right stock in the right tribe means nothing if you can't survive owning it emotionally, and Lynch was almost brutally honest about the odds involved here. He mentions that if 7 out of 10 of his stocks perform as expected, he's delighted, and if 6 out of 10 perform as expected, he's thankful. A confession that should permanently change how you judge your own inevitable losers. Sit with that for a second, because it's a personal confrontation this entire method has been building toward. A legendary investor with a 29% annual return was wrong roughly 4 times out of every 10 swings, and he still built one of the greatest track records in financial history. If your own portfolio has ever made you feel like a failure because one position went red, you are holding yourself to a standard Lynch himself never claimed to meet. The goal was never perfection. The goal was tilting the odds patiently over and over until the winners outweighed the losers by enough to matter. This is where the false ending almost arrives, because you might assume the file closes here with a checklist and a confession about win rates. It doesn't. Lynch identifies an emotional cycle nearly every investor cycles through, moving from concern into complacency and finally into capitulation. And understanding that arc is the genuine deeper layer most summaries skip entirely. Concern is healthy skepticism. Complacency is when you stop checking the fundamentals because the price has been calm for a while. Capitulation is the moment fear finally wins and you sell at the exact bottom, converting a temporary paper loss into a permanent real one. Lynch's answer to that entire emotional cycle is deceptively simple, and it's the internal monologue this whole file has been quietly building toward. If you can follow only one piece of data, follow the earnings, because sooner or later earnings make or break an investment in equities, while what the stock price does today, tomorrow, or next week is only a distraction. Your portfolio doesn't need you to predict the market's mood. It needs you to keep watching the business itself, quarter after quarter, and trust that price eventually follows profit, the way a shadow follows a body. Remember the 2 questions we open this entire masterclass with. The first, about why professional training becomes a cage, is now answered. It's the rigid, permission-based structure that keeps professionals reacting to opportunities you can move on freely and immediately. The second question, the personal one, resolves here too. It was never about the market outsmarting you. It was about whether you trust your own daily observations enough to act on them before Wall Street ever noticed. That trust, built patiently, is the entire verdict of this file. Key lessons and insights. The boring advantage. Let's name the first lesson from this masterclass, the one we call the boring advantage. It applies to leadership and money in equal measure. This resolves the first open loop we planted at the very beginning about why professional training can quietly become a disadvantage. Professionals are trained to chase excitement, headlines, and complexity, while Lynch's fortune was built on companies almost nobody wanted to talk about at a dinner party. In your own career or business, the unglamorous, overlooked work is frequently where the real compounding happens, precisely because your competition has already stopped paying attention. The mirror before the market. Name the second lesson, the mirror before the market, because readiness always precedes opportunity. Before Lynch let anyone touch a stock, he made them examine their own house, their own edge, their own timeline. That same discipline applies far beyond investing. Before you chase any ambitious goal, whether it's a business, a relationship, or a personal transformation, ask honestly whether your own foundation can withstand the volatility that pursuing it will inevitably bring, because ambition without a stable base collapses under its first real test. Know your tribe. The third lesson is know your tribe, drawn directly from Lynch's 6-category system, and it applies to people just as precisely as it applies to stocks. Judging a slow, steady friendship by the intensity standard of a fast-moving one creates unnecessary disappointment in both directions. The same logic holds for your own goals and even your own body. A slow grower phase in your life isn't a failure. It's simply a different category of season, and mistaking one category for another is how people abandon good decisions for the wrong reasons entirely. The 6 out of 10 truth. Call the fourth lesson the 6 out of 10 truth, because this directly resolves the emotional weight so many ambitious people carry in silence. Lynch, one of the greatest investors alive, was wrong roughly 4 times out of every 10 attempts, and he still built a legendary career. If you've been quietly punishing yourself over failures in business, discipline, or relationships, recalibrate your definition of success right now. It was never about avoiding losses entirely. It was about making sure your wins, patiently and repeatedly pursued, outweighed them over time. The earnings principle. The final lesson is the earnings principle, and it's the most transferable insight in this entire masterclass. Price, attention, and noise are distractions that fade, while sustained effort, output, and fundamentals are what actually compound over a lifetime. Whether you're building a business, a body, or a body of knowledge through memorization and discipline, the temporary fluctuations in how you feel about your progress matter far less than whether the underlying fundamentals, your consistency and your effort, are quietly strengthening beneath the surface every single day. The vault closing. There's something underneath this book that has nothing to do with stock tickers at all. Lynch's real argument was that ordinary attention, applied consistently and honestly, beats extraordinary credentials applied carelessly. He wasn't handing you a shortcut. He was handing you permission. Permission to trust what you already notice in your own life, your own industry, your own daily habits, instead of outsourcing your judgment to people who've never actually walked through the world you live in. That permission is worth more than any single stock pick in this entire book. Here's your concrete action for the next 7 days. Write down 3 products, services, or businesses you've genuinely noticed thriving in your own life recently. The ones with lines out the door, or the ones your friends won't stop mentioning. Then spend 20 minutes on each one, checking whether their fundamentals actually support the enthusiasm you're seeing. Not to buy immediately, but to practice the exact muscle Lynch built his entire career on, the discipline of turning observation into research before research ever turns into action. And remember the second question we opened with, the personal one beneath all the market talk. It was never really about Wall Street outsmarting you. It was about whether you trust yourself enough to act on what you already know before someone else profits from your hesitation. If this masterclass moves something in you, hit like, subscribe, and drop a comment with the one insight from this book you're taking with you today. This vault was built for people done waiting on permission from anyone else, and there's a community of us growing right here, one honest observation at a time.